Good morning. It is our pleasure to welcome today the new chairman of the CFTC, Wendy Graham, the chairman of the SEC, David Ruder, the distinguished Undersecretary of the Treasury for Finance, George Gould, and Senator Nicholas Brady and Robert Glauber, who have served the nation well in producing the Presidential Task Force report on the October market crash. We have now had 5 months to absorb the shattering experience which befell our financial markets during October of 1987. What have we learned? What are the policy implications for those of us in Washington who watched and waited on October 19th as the 5-year bull market careened wildly downward like a freight train that had suddenly run out of tracks? Perhaps the greatest immediate danger we face is complacency. The markets appear to have regained a certain stability. A few new offerings are making their way to market, and traders don't seem quite so jumpy. Yet, all is not well in Camelot. In recent weeks, I have been communicating with leaders of all segments of our investment markets. Speaking privately, their message is startlingly uniform. They all agree with Nick Brady, whom we all owe a great a great debt for tirelessly spreading the news that others fear to speak. As he says, quote, "We are looking down the barrel of the same gun, and it is still loaded." Living in this Prague Spring of quiet but nervous markets, it is imperative that Brady's message not suffer the fate of a modern-day Cassandra, that we stand up to the fact that there are fundamental flaws in our market mechanisms and regulatory structures, and that they are not susceptible to easy or painless solutions. These are matters which demand the most serious attention of our public and private institutions, and a commitment on the part of all of us to reach beyond our parochial concerns to address the fault lines in our regulatory structure which so nearly resulted in catastrophe on October 20th. Everyone on Capitol Hill wishes the markets could cure themselves. The industry and the self-regulatory organizations have been given opportunity and encouragement to effect intermarket agreements which address short-circuiting of future downward cascades in our unified financial markets. A number of unilateral initiatives have already been undertaken in several marketplaces. The Chicago Futures Exchanges have voluntarily increased initial margins and created price movement limits on their contracts. The NASDAQ system has adopted new regulations which ensure that all orders entered into their small order execution system will be executed automatically, regardless of market conditions. The options exchanges are revising their formats for creating and opening new series of options, and the New York Stock Exchange has made their dot computer system unavailable for program trading on days of excessive market volatility. And this is by no means an exhaustive list. There can be no doubt that all of these efforts are undertaken in good faith by well-meaning persons, but there remains the nagging perception that we are dealing on an ad hoc basis with deadly serious intermarket relationships that require and deserve comprehensive reform. Indeed, in their desire to do something to address the perils inherent in the genie of the unified market, commentators warn that our equity and futures exchanges, by acting independently and inconsistently, may inadvertently release new and catastrophic consequences in the days and months ahead. We can talk a great deal about the changes that are taking place in the world with regard to national productivity, international competitiveness, and America's proper role in these processes. But if the capital markets fail us because of some structural dysfunction exacerbated by either the absence of proper regulation, the intrusion of antiquated regulation, or ill-conceived self-regulation, we will have only ourselves to blame. The President last week announced the formation of a working group on financial markets, whose real purpose remains something of a mystery. To the extent this initiative seriously undertakes to knock heads and meld the disparate views of the administration's free marketeers and its pragmatic interventionists, forcing a comprehensive reform package which the administration can stand foursquare behind, we applaud the process. It is imperative, however, that Congress not be seduced into any further waiting games. Despite formidable political obstacles, we must find the political will to put the national interests of our financial structures ahead of the pocketbook concerns of special interest constituencies. We must recognize the unity between our futures and equity markets and regulate stocks and stock indexes in a single agency. We must provide a single regulator to set margins in both markets at equivalent levels so that undue leverage does not exist between markets. We must provide for cross-market price movement limits and trading halts in emergency circumstances. We must reform and unify clearing and credit system. We must take steps to bolster market maker liquidity in all markets. We must prevent abusive and destabilizing strategies such as front-running and unrestricted short selling. In written testimony for today's hearing, Senator Brady observes that, quote, "Our central need is to adapt our regulatory system to the structure of today's markets and to the demands we place on them. October exposed a number of shortcomings in the financial markets. The greatest mistake would be, either through inattention or inaction, to leave these weaknesses in place." Unquote. I am increasingly convinced that the greatest danger facing our financial system is the safe course of delay and inaction. For my part, I am committing this day to the task of moving legislation that will bring individuals back to the marketplace and that will renew the capital formation process instead of crippling it. And in my judgment, Congress must do it this year. With that, the time for opening statement by the Chair has expired. The Chair recognizes the ranking minority member, the gentleman from New Jersey, Mr. Rinaldo.
Thank you very much, Mr. Chairman. I want to join you in welcoming our very distinguished first panel, and in particular the new chairperson of the Commodity Futures Trading Commission, the Honorable Wendy Graham. Let me begin by commending you for holding today's hearings on possible, and I emphasize the word possible, legislative recommendations to address the stock market break. Last October's market fall obviously sent a chill around the world. We watched as equity and derivative markets dropped precipitously in a downward spiral. Fortunately, the decline slowed and the markets reached a new equilibrium. Nonetheless, those were very scary days, not just for investors, but for all members of the public. Since last fall, the markets have regained a portion of their vitality, and some investors have returned to certain segments of the markets. But it would be foolish simply to try to forget what happened during the market break. It can happen again, and Congress in general, and this subcommittee in particular, have the responsibility to review what happened last year and to ensure that appropriate steps, whatever they may be, are taken to reduce the chances of a repetition of the crash. Fortunately, our task is made much easier because of the work of the organizations represented here today. Experts at the Brady Commission, the CFTC, and the SEC have spent thousands of hours trying to grasp why the Dow Jones average fell 508 points in one day and what regulatory changes are needed as a result. The reports have provided a wealth of careful analysis and have been very helpful to all who are concerned with our capital markets. However, these reports differ substantially in the reasons they cite for the market break and the remedies that they feel should be put in place as a result of that fall. Just last week, as the chairman mentioned in his opening statement, the White House announced the formation of a new task force to try to reconcile these efforts and to formulate a comprehensive and consistent set of recommendations. I might add parenthetically that perhaps a better word would be to force better coordination among the markets. Perhaps that's their prime mission, and I certainly commend that effort and await the working group's recommendations. The working group has a broad mandate to look at the markets and to develop workable solutions to the problems that are out there. Today's hearing will give us the opportunity to explore where the existing reports and where the experts agree and where they differ, why they agree and why they disagree. It'll give us an opportunity to grapple with difficult issues. It'll give us perhaps an opportunity to determine what legislation is appropriate, what legislation is practical, and what legislation can be enacted. But I think when you look at the broad perspective at this stage of our deliberations, of our inquiry, we can safely reach only two conclusions. First, derivative products serve useful economic and investment purposes, and in my view are here to stay. As a result, we need a regulatory system that accommodates both equities and derivative products. Secondly, I feel that the only way we could outlaw another stock market break would be to close down or to outlaw the stock markets. This committee isn't going to be able to do that. No committee of Congress or the administration or anyone can say that any type of regulation, new, revised, or what have you, or any type of legislation can stop another break. If stocks are overvalued and if certain factors interplay with interact with one another, we can have another break. And I think everyone has to face up to that fact. But our goal, in my view, should be to reduce the likelihood of that break occurring because it's futile and I think it could be harmful to attempt to do more. I will insert at this point, Mr. Chairman, request unanimous consent to insert my statement in its entirety in the record, and I look forward to the testimony of our witnesses and want to thank them once again for their appearance here this morning.
Without objection, the gentleman's statement in its entirety will be included in the record, as will all of the written statements of all of the subcommittee members, and all of the written statements of our witnesses today, without objection, will be included in the record in their entirety. Any other member seeking recognition for the purpose of making an open statement? The chair recognizes the gentleman from Oklahoma, Mr. Sinar.
Thank you, Ed, very much, and I do appreciate the opportunity to be here and also welcome all the witnesses today. It is very clear that since October, two facts have evolved with respect to the markets and the problems that we face in those markets, and that is, fact number one, is that there are basic flaws in our regulatory structure and markets that must be addressed. And secondly, and more importantly, I think that the Brady Commission, Kassenbach Commission, and other reports that have been done clearly point that changes need to be made. The two questions that remain as we enter this phase of the hearing process is, how broad should those changes be? As one who comes out of a business background and one who has studied very closely the markets for not just the period of time while they've been in Congress, but during their whole education process, I think I could come down on the side that we don't need to reinvent the wheel. However, basic changes are necessary. The second major question is, and the question which I hope the committee can find some consensus on, is who should make those changes? And I am attracted to the comment by our chairman, Mr. Markey, that we should not and cannot be seduced into a waiting game of continued commissions and studies. It is very clear in visiting with constituents in Oklahoma, ranging from the traders and investors in the small brokerage houses to the farmers who hedge in order to protect their product, to the small businessmen who invest periodically, and finally the small investors who are literally at the mercy of their individual brokers in the communities of Salisaw and Pryor and Muskogee and Okmulgee, that they've lost confidence in the ability of the regulatory agencies of this country to give them the type of protection that they need so that they can feel that they're playing in a fair arena. They're turning to Congress, people who are accountable, who must address them on a daily basis, and asking them to join with them in making sure that these markets are fair. And I hope that I can join with Mr. Markey in moving forward in a legislative package, because I think it is our responsibilities as members of Congress to do it. And I hope that we can find members on both sides of the aisle that feel that we have studied it clearly, we've had the necessary hearings, and that we should move forward. And I thank the chairman for the hearing today.
Very much. Chair now recognizes the gentleman from Ohio, Mr. Oxley.
Thank you, Mr. Chairman, and I'd also like to welcome our panel today and wish Ms. Graham the best of luck in her new job. Mr. Chairman, needless to say, all of us present are keenly interested in the forces and mechanisms which affect our country's stock and futures exchanges, and we've been waiting for the opportunity to hear from the organization represented by today's panels. It goes without saying that maintaining the viability and soundness of the markets is critical to our economic well-being. Because of the different constituencies involved, the agencies and commissions have varying and sometimes conflicting ideas about what reforms, if any, should be implemented. The investing public is looking toward Congress and the agencies to create the balance that might not be attainable by the exchanges and markets. As we all know, the President recently issued an executive order which created a working group on financial markets. This group is charged with reporting recommended reforms back within 60 days. I do not interpret this time period as any sort of moratorium on Congress creating solutions that would not be amenable to the regulators and self-regulating organizations. Therefore, I look forward to hearing the different recommendations today in hopes that we will be able to move forward. Mr. Chairman, having said that, it seems to me that we are in a position of looking back with some degree of ability to look in the last 5 months as what's happened in the market. And in many respects, the predictions of doom and gloom that we saw in the national news magazines, every national news magazine, excuse me, either had the word recession, one even had the word depression immediately after the October 19 stock market crash. And clearly those predictions have not come true, fortunately, for the country. I think the worst thing this committee can do, Mr. Chairman, is to panic, much as many of the investors did on October 19. This is the time to call for careful deliberation that the process can go forward in a timely yet restrained manner, so that all of the parties who are involved in this and the issues that are so crucial to the financial markets can be clearly aired in a public forum, and then a consensus reached, and then those decisions made in this body. And I yield back the balance of my time.
Great. Gentleman's time has expired. The chair recognizes the gentlelady from Illinois, Mrs. Collins.
Thank you, Mr. Chairman. I, along with my colleagues, also commend you for the diligence our subcommittee has shown in identifying the causes and events which led to the October 19th stock market crash. As one who's followed the surrounding events with avid interest, I'm pleased to note we have embarked on a more thorough and balanced examination of all the actions which helped trigger the massive selling on Black Monday. Initially, in the aftermath of the crash, the finger was pointed directly at the throat of the Chicago futures industry. Program training, index arbitrage, and institutional dumping were products which were singled out as the culprit of the market decline. Since that time, we've had time to step back and sort out contributory causes and digest the conclusions of numerous studies conducted by the Securities and Exchange Commission staff, the Chicago Mercantile Exchange, the Commodity Futures Trading Commission, Government Accounting Office, the Brady Commission, and the Katzenbach Report. Since October 19th, we've had the opportunity to focus on other major contributory factors, specifically the undercapitalization of specialists, the inability of some specialists to maintain fair and orderly markets, and the inadequate performance of the New York Stock Exchange computer system. In addition to highlighting questionable conduct on the part of specialists, the studies have, for the most part, informed us that there really is no single cause for the market decline. We have also learned that better coordination is needed between the CFTC, the Federal Reserve Board, and the SEC. That increased investor protection must occur, and that a comprehensive contingency plan is needed. In the midst of absorbing what we have learned and continue to uncover, the SEC, the Federal Reserve Board, were until March 18th actively working on legislative recommendations. Their actions have, of course, been placed on hold with the creation of the new working group. It has been established by the executive order courtesy of our president. I look forward also to any legislative changes this new group may propose. With that as my backdrop, let me join my other colleagues in welcoming all of the witnesses today, and I extend a special welcome to Commissioner Wendy Graham of the CFTC. I look forward to your presentations as a panel and to learning how we can guard against another serious market decline, and yield back the balance of my time.
Great. Gentlelady's time has expired. The chair recognizes the gentleman. This gentleman from Utah seek recognition? No, the chair recognizes the gentleman from Indiana, Mr. Coates.
Thank you, Mr. Chairman. I don't have a formal statement. I also want to welcome Ms. Graham to and congratulate her for her new appointment. She's the wife of a former member of this distinguished committee. We are glad that you are where you are and look forward to working with you. And secondly, Mr. Chairman, just to emphasize once again how important I think it is that the committee continue a thorough yet deliberative approach to the issues at hand. These are complex issues. They are difficult issues to fully comprehend and understand how they interrelate to each other. And I think it's important that we have as much information before us as possible before we take any legislative action that we may later regret. There are a number of studies that we need to pay attention to. I look forward to the contributions that the panelists will make today to this body of knowledge, and thank you again for your continuing interest in this and for, frankly, not rushing the committee to judgment based on some trading that took place and activities that took place late in October. So we look forward to hearing what everybody has to say, and again, welcome Ms. Graham to your new position.
Any other members seeking recognition for the purpose of making opening statements? The chair notes that no other members seek recognition for that purpose. So we'll turn to our first panel, which consists of the Honorable David S. Ruder, Chairman of the Securities Exchange Commission, the Honorable Wendy Graham, Chairman of the Commodity Futures Trading Commission, and the Honorable George D. Gould, Undersecretary, Department of the Treasury. In our written request to each of you, we ask that you limit your opening statements to 5 minutes. We will ask you to abide by that. Give us your key points, please, that you think that we ought to have in our minds so that we can go through that first 15 minutes. And then I promise you, you'll have plenty of opportunity to elaborate in the question and answer period with the members of the subcommittee. So let us begin with David Ruder, Chairman of the Securities Exchange Commission. We welcome you once again before us, David, and look forward to your testimony.
Thank you, Chairman Markey and members.
Could you turn on the microphone, please? Could you turn on the microphone? Right there, yeah. Good.
Thank you. Thank you, Chairman Markey and members of the subcommittee, for inviting me to testify before you today on the October market break. I have submitted written testimony to the subcommittee, and I'm pleased that it will be made a part of the record of these proceedings. As we all know, the market events of October were very dramatic and historic, and their effects are still being felt. While these events showed how resilient our markets are, they also revealed weaknesses. In particular, we now know that new market structures and trading strategies at times can cause volume and volatility that overwhelm the current capacities of our markets. We have been warned that our modern markets are not working well enough. The weaknesses in October must be corrected, and the Securities and Exchange Commission has the major responsibility to seek correction of these weaknesses. I believe that the failure to act in light of the October warning would not be an acceptable response. I believe further that cooperation and coordination between the CFTC and the SEC is essential to our task. On February 2nd, 1988, the Commission staff released its report on the market break, copies of which have been made available to this committee. On February 3, 1988, the Commission announced its own conclusions and recommendations, which are detailed in my written testimony to the committee. As a general matter, the Commission recommends concentrating on improving the capacities of the interlinked equities and derivative index markets. The Commission's primary recommendations are to increase the efficiencies of automated systems, to increase available capital and liquidity, and to increase coordination among markets. We have urged the reduction of liquidity demands through temporary margin increases as a desirable interim measure, but we continue to believe that increasing the efficiency of the interlinked markets and improving intermarket coordination offer the most important avenues to improvement of the markets. Since the market break, the securities self-regulatory organizations have taken substantial steps to improve the efficiencies of their markets, steps that are detailed in my written testimony. The Commission will continue to work with the self-regulatory organizations to ensure further improvements in this area. Since October, the Commission, the Commodities Futures Trading Commission, the Federal Reserve Board, and the Securities and Futures self-regulatory organizations have all worked hard toward increasing cooperation and coordination. The agencies and the self-regulatory organizations have made progress on emergency communication and planning and cooperative efforts in other areas. The Commission will pursue increased cooperation and coordination as diligently as we pursue intra-market improvements. In this connection, as you know, on Friday of last week, the President signed an executive order establishing the Working Group on Financial Markets. This group consists of the Secretary of the Treasury and the Chairman of the Securities and Exchange Commission, the Commodity Futures Trading Commission, and the Federal Reserve Board. The purpose of the Working Group is to formalize and facilitate the interagency cooperation that has been occurring since the market break. The Working Group has been asked to review market conditions and solutions offered by various studies and reports in the areas of investor confidence, credit system issues, market mechanisms, and regulatory structure. I am hopeful that agreed solutions to many of the problems in those areas will be forthcoming as a result of these cooperative efforts. As detailed in my written testimony, during the last 6 weeks, I have been active in seeking improved international coordination and cooperation. I've recently traveled to Japan and to the United Kingdom, where I had useful conversations with a variety of regulators and market participants in those major foreign markets. International coordination is another priority area, one to which the Commission will devote substantial attention in the near future. In summary, I strongly believe that while October showed market strength, it also revealed weaknesses that must be corrected. The Commission is committed to working with the self-regulatory organizations, other agencies, the administration, and Congress to maintain the fairness, orderliness, and competitiveness of our nation's securities markets. Thank you.
Thank you, Mr. Chairman. Our next witness, the Honorable Wendy Graham, representing the Commodity Futures Trading Commission. Welcome.
Thank you very much. I would like to keep...
Again, could you turn on your microphone as well, please? Thank you.
Let me just briefly summarize the statement. We have detailed in my statement all the activities that the CFTC has undertaken and has recommended as a result of the October price break. And a lot of these recommendations that we have made, and there have indeed been further activity by the exchanges and the self-regulatory organizations. Basically, upon our review of both the financial underpinnings of the futures systems and in the operation of the exchanges during the October price break, we have identified some areas where improvement can be made, and much has been done, as you have indicated. Most importantly, there have been quite a number of actions to reinforce the ability of participants in futures markets to withstand extreme price volatility, indeed to withstand the financial pressures that price volatility places on participants in futures markets. I should point out that during this period, no customer lost funds due to any futures firm default. Indeed, there were very few customer complaints during this period as well. Execution of orders in the futures markets was implemented on a timely basis. However, We have asked the exchanges, and the exchanges have implemented further protections, not only to ensure that in case of extreme price volatility in the future, that financial systems are protected as well as customer funds will be protected, but also to help enhance customer confidence and investor confidence as well. There are a number of other changes that have been made during this period, during the 5 months, such as improving the information systems. Again, the information systems in the futures markets were very good and formed the basis for a number of the reports. You have to remember that this is, because it's a professionals market in some sense, there are a lot of reports that are made regularly to the CFTC. Nonetheless, we are indeed improving and seeking ways that the information systems can be improved, and indeed where you can share information among the exchanges as well as the clearing organizations to further enhance the efficiency of the system. Coordination and communication is something that is very important. In my view is that we ought to enhance it. But let me point out that just because you don't hear about meetings necessarily in the newspapers, that doesn't mean that coordination and communication isn't occurring. There have been a number of meetings, not only among the exchanges, but among the regulators, among international regulators as well. As Chairman Reuter pointed out, what we learned in October, not only were that these markets are linked, but that they're global markets as well. And that, so there's an increased need for international cooperation as well, and that is ongoing on a continuing basis, not only at our level and my level personally, but at staff levels as well, and I think that is appropriate. Indeed, in addition, there are emergency measures that have been undertaken by the exchanges to cushion the impact of a price decline should one occur. These actions are all aimed at enhancing financial security and improving the efficiency of the systems. I might point out that, as Chairman Reuter has said, there are a number of relatively new practices, new instruments. Indeed, portfolio insurance, for example, has been on the market since the early 70s. We have stock index futures that have been available since the 80s. These markets are increasingly international in scope. There are a lot of institutional actors, institutional traders in the markets on a much larger scale than before. I think that's in part due to the fact that as Americans become more prosperous, we also diversify and we've learned to specialize, and a lot of us have put our money in mutual funds. You've had a growth in pension funds, and as those pension fund managers seek to manage their funds effectively, they use new instruments. These are changes that have occurred over the years, and if they overwhelm the capacities on the markets, what we need to do is focus on the markets to try and expand those capacities to ensure that these traders can trade effectively and efficiently when they want to. We must not rush to throw sand in the gears or put peanut butter in the gears, as one person has so aptly described it, because after all, the regulatory structure that we place on markets within the U.S. is part of the cost of doing business as well. So I commend the fact that you are having these hearings and are interested in gathering information so that whatever other changes you might want to direct or that we might want to undertake as well are ones that are carefully thought through so that we don't send our markets overseas. Thank you very much. I'd be happy to answer any other questions.
Thank you very, very much. And our final witness on the first panel is the Honorable Judge Gould, who is the Undersecretary from the Department of Treasury. Welcome, Mr. Gould.
Good morning, Mr. Chairman and members of the subcommittee. It's a pleasure to be here to discuss the administration's newly created working group on financial markets. As people have said before me, you are to be commended for your timely oversight of these issues, which are critically important both to the integrity and the competitiveness and the efficiency of our country's markets. I have a rather short statement I would like to read, and then I would be glad, at your convenience, to answer any questions that the subcommittee may have. The extraordinary events surrounding the October market decline should concern us all. The 5-year bull market culminated with the sharpest price break on the highest volume we have ever experienced. Whether you call it a correction or a crash, the system came close to a point that none of us wants to repeat. The events of mid-October were a clear warning that it is no longer business as usual. New technologies, products, and trading strategies, together with cross-market linkages, globalization, and institutionalization, profoundly affect the financial environment. These innovations raise fundamental questions about U.S. competitiveness in world financial markets, with implications for both the capital-raising process and investor confidence. At the same time, it is important to recognize that the system performed remarkably well during the events of mid-October. It was down, but certainly not out. Indeed, without minimizing the weaknesses that need to be corrected, the market's resilience, the responsiveness of the Federal Reserve, and the effectiveness of our regulatory and self-regulatory system stand out among the great strengths of our financial system as a whole. Events of last October have underscored the need for sufficient capital to withstand market risks, a theme that the Treasury Department has sounded repeatedly in recent years on a variety of financial issues. In the final analysis, adequate private capital can and should serve as a protective buffer to market disruptions. During October, the Treasury Department was in close contact and consulted with an array of regulators and market participants, including the Federal Reserve, the controller of the currency, the Federal Deposit Insurance Corporation, the Federal Home Loan Bank Board, the Securities Exchange Commission, the New York Stock Exchange, Commodity Futures Trading Commission, the Chicago Board of Options Exchange, and the White House staff. Our efforts were to monitor the situation to ensure particularly that those regulators with direct supervisory authority were doing everything they could to prevent the situation from worsening and to anticipate possible weak spots in the system which could become problems in the future. The Treasury Department, as you know, has no direct regulatory or supervisory authority other than in the government securities market. As you would expect, we are continuing to consult with the agencies involved and others on a regular basis at a variety of levels and to monitor financial market developments closely. There are no easy answers to the problems that have been raised. The dimensions of this new environment pose major challenges and opportunities. This is the time for careful consideration, cooperation, and constructive action. A number of useful studies have been completed, including the report of the Presidential Task Force on Market Mechanisms, headed by former Senator Nicholas Brady. The Brady Commission's analysis of the events surrounding the break have proven to be a useful starting point for discussions on a very complicated subject. In addition, the other studies, particularly those of the SEC, the CFTC, the Chicago Mercantile Exchange, and the General Accounting Office, have sharpened the focus on these issues and begun a process that I believe will lead to meaningful improvements. Although all of the studies agree that the securities options and future markets are linked, there is considerable disagreement over the causes of the market break and how to prevent a recurrence. One of the primary issues clearly is the trade-off between market efficiency and measures designed to limit or slow the pace of price changes. All of the studies make valuable contributions to this debate, and they warrant careful consideration. Numerous steps have already been taken to reduce the likelihood of a recurrence. The SEC, in a March 4th letter to the Senate Banking Committee, included a summary of actions the self-regulatory organizations have taken in response to staff and SEC recommendations. The CFTC, in recent testimony before the Senate Agricultural Committee, also provided an extensive list of the actions the commodity markets have taken. The regulators and the self-regulatory organizations are actively exploring ways to coordinate programs, improve communications, and plan for emergencies. In addition, private participants themselves have taken corrective steps. For example, there has been a voluntary decline in the use of portfolio insurance by institutional managers now that they better understand the limitations on the market's liquidity. Perhaps the biggest improvement is simply the benefit of hindsight. We now know that differences in settlement and credit procedures among different closely linked markets can cause real problems, and that price discovery in the derivative and overseas markets can conflict with gradual price change in the cash market. Instantaneous news transmission and liquidity accessible via high technology, so-called keyboard liquidity, are realities. But so too is the fact that the system's capacity and human decision-making capabilities have not kept pace with the potential for temporarily concentrated orders. Despite improvements in market mechanisms, valuable studies, and the financial system's notable success in withstanding the shocks of the October events, it is clear that further, closely coordinated work needs to be done at the highest levels of our government and in the private sector. We need to ensure that the public is protected from possible credit market disturbances posed by high volumes of trading during periods of rapid price changes. We must also be concerned over the effects of price volatility, quality and fairness of markets, and availability of timely execution on both investor confidence and the willingness of individuals and institutions to invest in the equities markets. In addressing these issues, we must keep clearly in mind the vital national interest in preserving the efficiency and international competitiveness of our capital markets and financial institutions, and the ability of our companies to raise capital on internationally attractive terms. To these ends, on March 18th, President Reagan established by executive order a working group on financial markets to coordinate the government's continuing efforts to ensure that the events of last October are not repeated. The members of the working group of the Treasury Department, acting on behalf of the administration, plus the Federal Reserve, the SEC, and the CFTC. Treasury Secretary Baker is keenly interested in positive actions from this group and has designated me as the chairman of the working group. The goals of the working group are twofold. First, to ensure the continued integrity, competitiveness, and efficiency of our nation's financial markets, and second, to maintain the public's confidence in our equity markets. The working group will consult with the various exchanges, clearinghouses, self-regulatory bodies, and major market participants. We will report to the President initially within 60 days and periodically thereafter on the progress made to implement recommendations to achieve these goals. In the President's judgment and that of his senior advisors, the major items the working group will consider are investor confidence, credit and settlement risks, and the maintenance of orderly, efficient, and internationally competitive markets. Although much can be done within the existing legal framework by both regulators and market participants, the President has asked the working group to consider whether any legislative changes are required. The President has also asked us to advise Congress on our work and progress. Consequently, we intend to keep you and your staff up to date. It would be premature for me to say more at this time about the working group since it has not yet met. In fact, our first meeting is this afternoon. I have attached, however, as an appendix to my testimony, a copy of the President's recent executive order, the accompanying statement, and a list of issues on which the working group will focus initially. And I might add here that the thrust of this group is not further study, but rather to take the existing studies and see what actions are required. So the working group is a conclusatory group, one that wants to come to decisions and see what can be implemented within present legal framework and to see if something further is required. Mr. Chairman, we all have a stake in the soundness of our financial system. Whether one's perspective is from Wall Street, Main Street, or Capitol Hill, we share a common goal, keeping our financial system strong, efficient, and ahead of the competition. Thank you.
Thank you, Mr. Gould. That concludes the opening statements of the witnesses, and now we'll turn to questions from the subcommittee. And the chair recognizes itself for an opening round of questions. First of all, if we may, Mr. Gould, just so that we can understand who you are in this whole process now and what authority you have to resolve differences that exist between the CFTC and the SEC and amongst the exchanges so that we can have a speedy resolution of these issues. You are the chair of this group, is that correct?
Yes, sir. The presidential order designated the Secretary of the Treasury and the Chairman of the Federal Reserve, CFTC, and SEC, or their designees, and I am the designee of the Secretary of the Treasury.
So, in the course of the working meetings which you're going to have, are you in a position to make the tie-breaking votes in order to decide that certain recommendations should be made?
No, sir. I really do not see it as a voting group. I see it as a formalization of a consultation that's been going on.
Do you realistically believe that, in the absence of a tie-breaking vote, that any of these historic, long-standing, philosophic, and jurisdictional issues can be resolved?
Well, hopefully, without being naive, my answer would be yes, sir. If you look at the list of issues that are attached to the presidential order, what you see there is the work product of 2 months of effort on the part of the Treasury Department to go through all of the reports, literally all, that have been written, and abstract common themes, abstract differences, and make some judgments as to what are the important issues, the most important issues. We then shared that list of issues with the other members of the working group, and in our preliminary conversations, we have optimism that we will be able to resolve, certainly not every single one of them, but a major number of them. And those we cannot resolve, if there are such issues, I think we'll have created heightened sensitivity to those issues, as well as seeing whether legislation is required to resolve what can't be resolved by the efforts of the group.
Well, I don't want to denigrate heightened sensitivity as an objective, but I don't think that really is going to solve our problem. I think what we need is to have some sense of what your time frame is for having basically a conclusion that is dispositive of these issues. We're here in Congress being asked to basically wait yet another 60 days without having that be deemed to be the conclusion, since you're going to have periodic reports thereafter, which could effectively foreclose our ability to legislate. And we don't want to be put in a position where this legislative year ends and effectively we would be well after a presidential election deep into 1989, well, a year and a half perhaps after the crash. And we don't think it's wise for us to be put in that position, especially if legislation has to pass. So can you give us some sense of the urgency that you have in reconciling these issues and what you expect the role of Treasury will be in resolving these issues?
Well, I will try. I really think there has been a lot of study done by the members of the working group before now. So I would like to think we all come to the first meeting well up the learning curve, both as to the issues and as to the views on the issues. So it is my hope that we will very quickly distill down the list of issues attached to the presidential statement to those where we have serious and if we will, well-intentioned differences within the group. These are complicated issues. Some of them seem superficially easy until one intellectually tries to think them through. And then you find in many cases the cure may be worse than the disease. So these are not just turf battles or ego battles. There are some very difficult issues here to resolve in terms of major structural changes with markets. So I would hope we would be able to distill down very quickly to those areas where there are those disagreements, and then to outline those disagreements, to see where the differences of opinion exist in very specific terms. At that point, when we arrive at issues that we no longer seem to be able to work with, and I think we will get to that well within the 60 days, I think it is our duty to tell the President that we are at that stage, and then decide whether it is worth spending more time, whether it requires legislation, whether it requires some other structure.
Okay, I understand what you're saying, Mr. Gould. But, you know, we are working in perhaps the only city in America that would consider action 5 months after the major market break in our generation to be acting in a precipitous fashion. Only we would use that as a definition for precipitous action. 5 months later, with the Katzenbach, the Brady, the GAO, and a host of other reports that the agencies have also provided to us. In addition, all of these problems have existed since stock index futures were created. These are not new problems. These are not new jurisdictional disputes. These are not new financial scraps that have been just created recently. And our difficulty in viewing what you are proposing to us is that if further study is necessary, if you think that these issues are not yet fully understood by the participants or by those who will now have to resolve them, then we have to question what has been going on in the administration for the last 5 months. How long does it take to understand these issues? I know there's a lot of subtleties, but for God's sake, if you don't resolve them, we're going to be into 1989 with the marketplace, as Mr. Brady has done, as having a gun still pointed at its head. So when do you finally decide in 2 months? Can you give us a commitment that in 2 months you can come back before us and say, this is what should happen, here is the legislation, or can you not give us that commitment?
Well, again, I hate to prejudge a committee which has yet to have its first meeting, but it is my expectation, and indeed when we considered what time span should be put on this, we did so with the idea that we would be able to resolve. We would be able to see, this is, again, sir, I stress, is not just a study of the issues. The issues have been studied. It is how do we resolve it? What actions do we take? And it is my belief that at the end of 60 days, we will know what actions can be taken within the framework of existing law by this group and what actions may require something more.
Okay.
I take the word commitment very seriously, so I use it cautiously, but it is my belief that I will be able to do almost all that you ask.
Okay. Well, again, you know, the language which is most disturbing are the 3 words, and periodically thereafter. That escape hatch from the decision-making process is one which is open-ended. So we don't know, in fact, whether or not at this point you intend on resolving the differences that exist and the regulatory black hole that exists between the SEC and the CFTC. We don't know whether or not you intend on recommending a single agency to deal with the margins and so that we have some unity that exists in essential equivalence. We don't know if you intend on dealing with those issues. And if we don't have that certainty, then we might as well just begin to move forward ourselves.
Well, perhaps another way to answer your question, Mr. Chairman, is that the administration feels the time pressure just as much as anyone else. We are equally anxious to see whether significant structural changes in regulation or in markets have to be made, and we therefore will try to resolve this as quickly as possible. In the process, again, however, I would say that some of these issues are not easy of solution, and when solutions are come upon, it may be years before you know whether those were the right solutions. So we have had an existing market structure for a number of years. To substantially change it without a lot of intellectual input and hard thought, I think also has its dangers. So we hope to be able to create a balance of that will satisfy your and our sense of urgency, but at the same time not to do something that creates more harm than good.
I would say, Mr. Gould, that we don't want the perfect, however, to be the enemy of the good. We also know what demonstrably does not work, and this existing system does not work. So if you have to make some changes and then fine-tune it in the years to come, fine, do it. But don't tell us that because you don't have a perfect solution and the law of unintended consequences could work in any one of these particular areas, that you don't believe you should act in any fashion, then we're going to have some serious problems. And I guess I would ask, in conclusion, have you moved in at the President's request because he was unhappy with the inability of the regulatory agencies to resolve the differences? Is that why this has been created?
No, sir. This really goes back to the first report of the Brady Committee. And if it would be helpful, I'd be glad to put the President's statement at that time, January 8th, into the record, in which the President said that he thanked the Brady Committee and accepted their report, and that we would continue to study the other reports, and he enumerated them.
When did it take it?
That were on the table or would come out subsequently. And that's precisely what we've been doing. Since that time, we have been studying the Brady Report and all the reports. And in the process of that, I think it became more and more apparent to the Treasury, who were really leading this effort for the administration, that there was much that could be done if we formalized the discussion process among the regulators and indeed establish a process, as some of your colleagues referred to in their opening statements, that kept the pressure on the private system, that kept the pressure on people to resolve issues. And that's what we think we have created here. So it's really been an evolutionary thought since the first Brady copy was given on January 8th.
Okay. My only hope would be that the 2-month gap that elapsed between the introduction of the Brady Commission report and the announcement of the formation of your new panel doesn't reflect the timetable that is going to be established for the resolution of these issues, because I think it was clear even at that point, knowing the history of these agencies and the difficulties that exist between the exchanges and their perspectives of the difficulty in resolving the issues.
Well, it does reflect, I honestly believe, 2 months of very hard work on the number of people in the Treasury, and the SEC report was subsequent to the Brady report. I personally found it fascinating, but it was 900 pages, and it took a while to
well written,
to digest. Well written, and we, as again I will say, have a sense of urgency, and we will do our best to meet your standard.
Thank you, Mr. Gould. Chair recognizes the ranking minority member once again, the gentleman from New Jersey, Mr. Rinaldo.
Thank you very much, Mr. Chairman. Mr. Gould, let me continue with that line of questioning, if I may, because I think the members of this committee are somewhat in the dark about exactly what the function of this new group that you're heading is. For example, you said, first of all, you've been studying and are going to study the reports. You said there's much that could be done if we formalized action among the agencies. You're going to come up with a report. You said there are things that this group can do. Now, the only way you could do anything, I assume, would be through some regulation by the Treasury. Is that correct?
No, sir. What I meant by that statement was that certain authorities exist within that group as regulators, previously granted authorities in legislation, and that as you go down that list of issues which we identified, which is attached to my testimony, and you look at them, you find that within that group of 3 regulators, there is adequate statutory authority to deal with the issues. The only time perhaps, and again I don't want to totally prejudge this, but the only time perhaps legislation will be needed on those issues is if there is disagreement within the group.
And then I assume at the conclusion of the 2-month period, you intend to come back up to the Hill or to issue a report with legislative recommendations if you feel they are needed.
Yes, I would expect the procedure for that would be that as the chairman of the group for the President, I would make those recommendations to the President, and the White House would follow on from there.
I would assume one of the things you intend to do is to look at the recommendations of the different agencies and of the Brady Commission, and then cull out certain recommendations that you feel are or should be implemented, and either have them implemented by the agencies, or if legislation is needed, come back here and request that kind of legislation. Is that
yes,
an accurate statement?
If I could ask you to, if you have it in front of you, sir, turn to the...
Page 2?
Page 2, yes, sir. After the statement by Mr. Fitzwater, you will see the issues for consideration of this group divided into the 3 categories I mentioned in my testimony. Those are basically, that is the abstraction after our work on all these reports of what we consider to be the major issues to be resolved. And we, as I mentioned earlier, we have shared those issues with the 3 regulatory agencies, and we have agreed that those are the agenda. And the purpose of this group is to take that list, which is not necessarily an exclusive list, but is the first cut at this, and try to resolve those issues, to try to come to action points for those issues. What do we do about it? And then that's the list of what we're going to say, what has to be done.
Is the purpose of your group also to coordinate some of the actions that the agencies are taking or intend to take, and also to take a look at some of the actions that have been taken by the exchanges and the markets to see whether or not there is any coordination, and if a lack of coordination is unveiled, to then attempt to see that these things are coordinated?
Yes, sir. Within that working group, again, I believe there to be the authority and the power to keep things moving along among self-regulatory organizations, among private parties, and much as the chairman was outlining, we are anxious to create action from this, not simply more discussion.
All right, let me just shift gears for a minute. One of the key issues was brought out by the chairman of the Brady Commission, Mr. Brady, and it was also brought out by the chairman of this subcommittee when he said in his opening statement that we must recognize the unity between our futures and equity markets and regulate stocks and stock indexes in a single agency. Now, the SEC suggests, or has suggested, that it should have jurisdiction over financial futures. The Brady report suggests that some agencies, such as the Fed, should have oversight over certain key issues, and the CFTC apparently believes that the current regulatory scheme works fine. And inherent in all of that are tremendous minefields, jurisdictional disputes, and other problems. I would like to ask Chairman Reuter and Ms. Graham to respond to this question. What specific regulatory objectives do you feel would be achieved by reallocating the regulatory authority over financial futures? And specifically to you, Chairman Reuter, do you still believe that it should be coordinated within one agency, and if so, what agency, or has your viewpoint changed somewhat since your initial statements in this regard?
My views have not changed since my initial statements in this regard. I believe firmly that the logical resolution of the regulatory problems in this area is to have a single agency be responsible for the regulation of both the stock markets, that is the equity markets, and the derivative markets, the markets that are trading products which derive from the equity markets. I believe that these markets are unified markets, and that a single regulator is necessary in order to make the right decisions in times of stress, and indeed of times in which one is planning for stress. I would emphasize, however, that the Securities and Exchange Commission and the Commodities Future Trading Commission have been acting cooperatively and will be acting cooperatively to attempt to solve those problems without legislation. We believe, and I think Chairman Graham will join with me, that we do not have time to wait for a legislative resolution of these questions, and that we should continue to work actively toward resolution of problems by cooperation and agreement.
If that system is working out fine, do you still maintain that it has to be changed?
I will have to see whether we can have the kind of agreement that I think is necessary in order to solve the problems which are facing our markets.
Well, that puzzles me somewhat, because now you seem to be moving a little away from your opening statement, and if you have that kind of cooperation and it works out well and the coordination is there, would you then possibly change your opinion and say that one particular agency is not needed? And if you don't change your opinion, would you tell us which agency you think should have this authority?
Yes, I doubt very much that I will ever change my opinion as to which agency should have the authority to regulate the unified market. That market is complicated now. The unification and the unified aspects of it are complicated now, and there are problems which will arise in the future that I think require a single regulator. And I think that the Securities and Exchange Commission is the proper regulator to deal with problems in a market which is essentially an equity product market with another market interacting with it.
If the jurisdictional problems and some of the other vested interests, if you will, if I could use that term, prevent that from being a reality, would you then support the Brady Commission recommendation for the Fed to take over?
No, I would not. No, I would not, sir. The Fed does not have the expertise at the present time to regulate the securities markets nor the futures markets. And I would believe that in order for the Fed to behave responsibly and make decisions which were based upon sufficient information and expertise, it would be necessary for the Fed to create a mini SEC and a mini CFTC within its own body. And that would give us another level of regulation, which I would think would be entirely inappropriate.
Chairman Graham, my time unfortunately is running out, so in the interest of brevity, could you perhaps respond to the same set of questions? I have every faith in your ability to remember those questions.
Absolutely, and I could add that I would probably be responding to these questions of Chairman Markey as well, because I did want to jump in at a couple points in time. But with respect to the jurisdictional issue itself, let me just say that we are the Commodity Futures Trading Commission. I've always wondered if maybe when this commission first got started that it wouldn't have been called the Futures Trading Commission, except we already had an FTC. But we are a futures trading commission. Futures markets are linked to the underlying cash markets. That's a known factor among futures traders, and I do commend the Brady Commission for pointing that out and making that widely known among the general public, that indeed futures markets, stock index futures markets, are indeed linked inextricably with the underlying stock markets, the underlying cash markets, just like any futures market. But futures markets have a different structure, a different regulatory structure, and also different purposes. We are indeed a risk transference, a hedging kind of market. Different than asset transference on the stock market side. We do a lot more at the CFTC of direct regulation and overseeing the exchange's direct regulation rather than a reliance on disclose and go. So our regulatory structure is very different, but we are a futures trading commission. We regulate futures in general, and we have developed the professional expertise in those areas. We do not regulate the oil markets. We do not regulate the wheat, corn. We regulate the futures markets. And so I would say that in terms of the jurisdictional issue, we have a lot of expertise in the agency for regulating these types of instruments. And indeed, I think that all the reports, if you look at a lot of the reports, you didn't have reports that said that these agencies somehow ought to be merged, and even in the preponderance of the reports, even the jurisdictional issue was not as clear-cut. The Vice President Bush had his financial task force at the beginning of this administration, and again supported the notion of functional regulation there. Jurisdictional disputes are, of course, as old as, I mean, they're around. They're as old as the hill. They do exist, and if those issues are issues that we will continue to discuss, I think it is worth discussing. However, I do think that indeed that the CFTC has the expertise.
Excuse me. The gentleman from New Jersey's time has expired, and we're going to have to move on now and recognize the gentleman from Oklahoma, and then I'm sure you'll be given plenty of opportunity to continue to expound on your views. Chair recognizes the gentleman from Oklahoma, Mr. Sinar.
Thank you, Mr. Chairman. Mr. Reuter, I don't want these questions that I'm about to ask you to sound hostile, but I'm awfully curious about a sequence of events here. Maybe you can help us on the record here understand this a little bit better. You know, when you testified before Mr. Proxmire, he asked you, he said, and I'm quoting here, would you, Mr. Reuter, on behalf of the SEC, provide those specific legislative recommendations for whatever you feel the Congress should adopt to improve your financial markets by March 4th? And since the SEC is an independent agency, I ask that you make this report without consultation with the executive branch. Would you do that? He asked you. And here's your reply, Mr. Reuter. We will make that formal report to you, sir, and it would not be normal for us to consult with the executive branch before providing legislative recommendations to you. Then, in a letter of March 17th, 88, you wrote Mr. Proxmire, where you said this is a letter to confirm our telephone conversation of March 16th. You said, nevertheless, in the view of the Commission's commitment to participate in a working group with the Commodity Futures Trading Commission, Federal Reserve, Department of Treasury, I believe it would be premature at this time to specify particular legislative initiative. Now, I note that that letter is dated March 17th, and then the next day, March 18th, is the executive order. Now, did you or did you not believe when you promised Mr. Proxmire that you had legislative proposals, that legislative proposals were necessary?
Yes, of course I did, because we had in our, yes.
Okay, the answer is yes. Then you obviously didn't turn those in by March 4th, did you not?
That's correct.
Okay. And then you said that you thought you could make those legislative proposals outside the scope of consulting with the executive branch, but now you've retreated from that promise and also kind of parameters, have you not?
Well, I'd like to explain and answer that, sir.
I'm asking you to clear up this confusion we have up here.
I'll give you one answer on the timing, just so that that's clear. After that time that I had promised to make a legislative report to Senator Proxmire by March 4th, I received and accepted an invitation to go to London to participate in an international clearance and settlement conference. It gave me an opportunity to meet the regulators in Great Britain. Previously, I had a commitment to go to Japan. Those two trips each took a week, and the trip to Great Britain interfered almost directly with the March 4th deadline. So we called Senator Proxmire's office and asked him whether or not we could delay submission of those legislative proposals for approximately 2 weeks, so that it would give me a time to come back from Japan, review the proposals, take them to the Commission, and submit them to Congress. In the meantime, just before I left for Britain, which was the week of the 5th or 6th, I don't have my calendar with me, we received a call from the White House explaining the possibility of this working group being established. I expressed great concern at that time regarding my obligations to Senator Proxmire, and I said that I thought that I was bound to send those legislative proposals to Senator Proxmire, and that I thought it was necessary for intervention by the White House in order to have Senator Proxmire satisfied that what was going on was indeed in the best interests of the country. Senator Baker called Senator Proxmire, and it was following that call that Senator Proxmire made public the White House initiative. I don't think it was the 17th, but probably the 15th or 16th, before we made our final decision to participate in this working group, and I may say that I am the head of an independent regulatory agency. My responsibilities are neither directly to the President nor directly to Congress. And I feel that I have an independent obligation to pursue these proposals in this entire area. So I spoke with Senator Proxmire, and the letter reflects the agreement that he and I reached, that it would be acceptable for him, for me to participate in this meeting. I gave him, I made several statements to him. One is, which I will make to you, is that we will continue to act independently and as an independent regulatory agency. And secondly, that I would give to Senator Proxmire in his March 31st, in my March 31st testimony to him, an indication of the directions in which I would be recommending legislative proposals.
Well, Mr. Ruder, let me interrupt you if I could.
That's the end of my
You have explained all this, but the point is that in February you thought and promised legislative proposals that were necessary. Now in March, after talking to the administration, you've determined that legislation is not necessary.
I did not say that, sir.
Okay,
I just had a colloquy with Mr. Rinaldo, asking whether or not I believe that regulatory jurisdiction over the futures market derivative index products should be in the SEC. That will surely be part of our legislative package.
In 60 days?
I haven't a date for submission of that.
Well, Mr. Ruder, in February you were prepared to give it to us by March 4th. Then after talking to the administration, you can't even give us a commitment or a time certain when you might come up with these legislative proposals. When are we going to get to the end of this?
What's that? I must say that I favor the establishment of this working group. It gives us a forum in which to address some very highly complicated and contentious
Mr. Ruder, do you
positions.
or do you not have legislative proposals?
I do not have them. I do not have them in a form which has been completely reviewed by me, nor in a form which has been approved by the
Mr. Ruder,
commissioners.
what is the day of the month here? What day of the month are we in?
23rd.
The 23rd. Did you not promise Mr. Proxmire by March 4th that you would have those? And did you not just say in your long extended remarks that your staff had been working on it and that all that was necessary was your final review of those? Now, do you or do you not have legislative proposals you could offer to Congress?
At this time?
Yes.
No, sir.
And when do you think those will be, since you said that you thought you should have
At
some by February?
At such time as I decide that it's appropriate to submit them in view of the necessity for cooperative efforts between the agencies. I do not believe that, despite the fact that I am entirely of the point of view that there should be a jurisdictional change, that this legislation should form the basis of controversy between the CFTC and the SEC. And
Mr. Ruder, could we expect to see it this year, or how long do you give this working group before you'll make those recommendations?
My own view is that the working group ought to reach conclusions far in advance of a 60-day period, and I will be pressing that group to move as quickly as possible.
So we can expect legislative proposals before the end of the first 60 days?
I am not discussing legislative proposals, sir. I believe that the primary objective of this group is going to get proposals which can be acceptable to both agencies and to the Treasury and the Fed if that need be, without going through the long and tedious legislative process necessary to reach resolution. I am in good faith on this, and
I'm not denying your good faith, and I don't mean to sound these hostiles, but anyone who's been watching this for the last 5 minutes of questionings would be hard-pressed to believe that you are sincere about proposing legislative proposals.
How can you say you respect my good faith and then say you doubt my sincerity, sir?
Thank you, Mr. Chairman.
The gentleman's time has expired. The chair recognizes the gentleman from Ohio, Mr. Oxley.
What about Howard?
Okay, the chair recognizes the gentleman from Utah.
Thank you very much. I'd like to follow up on that question. I would just make one general rejoinder before I ask questions, that we have several members of the committee staff on this committee, and we've been looking at this since October. I haven't seen any presentations or recommendations from the majority side on this particular one, even though they have 20 staff members to work on it. So I think it's ill-advised for us to jump on the witnesses here. But having said that, there's an article on March 10th, 1988 in the Wall Street Journal, Mr. Ruder. It mentions two different camps It mentions Commissioner Joseph Grunfest, who's quoted saying the market break is a panic caused by a lack of market information, but he says that any governmental efforts to interfere would be counterproductive, would throw sand in the gears of the markets. The other school was led by Richard Ketchum, Director of the Division of Market Regulation, quoting him as dismissing the lack of information theory. He says, Mr. Ketchum blames the dramatic changes in the trading strategies on the trading strategies of institutions during the last 3 years. Do you agree there are the two camps, and is this article accurate?
No, I do not believe the article is accurate, sir.
Which of these two theories, if assuming these are two theories that you've heard, do you subscribe to?
Well, the theories are not mutually exclusive. I happen to subscribe to both. I believe there were informational problems in the markets.
One says that government efforts would be counterproductive. The other said that they would need to make some dramatic changes. I think they are.
Well, if those, that's not as the way I read the article. The two theories, as I understood them, was one was the institutional trading theory, and the other was the information. But if you want me to take those two ideas, I would say they do not exist within the Commission. That we are in the process of looking at very, very difficult matters, and I think all of our commissioners are willing to look at legislative changes if they should be needed.
So government action would not necessarily be throwing sand in the gears.
Our recommendations in our reports